Unit 6 in this personal finance money management series. The unit of study is real estate. The objective is for students to be able to explore the housing process by comparing renting versus buying, understanding the importance of credit and deposit requirements, practicing real-world tasks like completing rental applications and writing checks, as well as researching homes using online tools to evaluate affordability and long-term financial impact. In this unit, we will discuss renting versus buying, and what is a mortgage. I open with students taking a quick look at what the top 5 cities are with the highest credit scores for renting in 2020. In San Francisco, you needed a 719 on average in order to be eligible to rent a place to live. In the entire slide deck, there is a lecture video, the one that you're actually watching me make right now, accessible to students for you to review in case you missed something or you were absent from class, or if you are a teacher showing this to your students or needing examples as to how I instruct this content, as well as guided notes hyperlinked here to this slide, as well as in other locations for your access. Those guided notes are a few pages long for students to be able to make sure that they understand the content and what's expected of them in this unit. We open by defining what real estate is, and by definition from Google, it is property consisting of land or buildings. The main types of residential real estate, residential meaning places where people reside or live, are apartments and condominiums. I typically like to define an apartment as a multi-family unit that has a majority of renters versus a condominium being somewhere where the majority of people are buyers. They typically are stacked upwards, not always, and you're going to typically have more than 5 units in that type of a residential setting. A single family residence is exactly how it sounds. One family is typically residing in that unit, versus a multifamily residence is anywhere from a single family home all the way up to a fourplex. And anything beyond a fourplex requires different lending parameters, and it switches from being residential to commercial lending. And that does make a difference when we're talking about obtaining a mortgage loan. Throughout the unit, you'll hear me refer to the configuration of bedrooms and bathrooms, referenced as the number of bedrooms first, followed by the number of bathrooms. For example, a 5-3 home has 5 bedrooms and 3 bathrooms. There's other common types of housing accommodations within the area that I live in California, which is a 2-1, 2-2, 3-1, 3-2, 3-3, as well as 4-2s. And they do get bigger and smaller depending on where it is that you are choosing to live. I give you this opportunity to watch this kind of silly video at your own leisure if you choose to. Renting a place to live. I always start by students telling me what is one thing they know or have heard about whatever the topic may be, and in this case, renting. Gives me a chance to get some ideas as to what my students already know. We then move into a renting checklist. First thing that we need to do is make sure that our credit score is high enough to be eligible to even apply. In Unit 4, credit, we discuss all of the different parameters as to how to establish credit, especially as a teenager, or also how to rebuild credit. Then I teach students how to research inventory, save up enough money for a deposit, which is also known as collateral. And then sometimes they will need to come up with the first and last month's rent, apply the credit application, sign a lease, write a check, and then complete a move-in inspection. Let's get it. First thing we need to do is build our credit. Depending on where it is that you live in the United States of America will determine how much your credit score needs to be in order just to be eligible to even apply. So know your credit score, know how much it is that you could potentially rent, and then consider establishing your credit one of the 4 ways that I discuss in my credit unit. We start with housing research. I give you a few different hyperlinks here to click around and look at different locations within the area that you live and identify somewhere that you might potentially want to rent. First step in the renting process after establishing your credit is saving up enough money for a deposit, because a landlord, the person that is renting the home to you, whether it's a home, an apartment, or fill in the blank other type of residential unit, is likely going to request a safety deposit. And the safety deposit is in place to protect the landlord in the event that you out of nowhere just move out, or when you do move out, you've damaged the property and maybe you decide not to pay for that damage. Well, this deposit is going to allow that landlord some level of comfort knowing that the expenses incurred in your moving out will be paid for based off of your security deposit. In theory, when you move out, if everything is identical to the way it was when you moved in, You'll get your safe deposit box, or I'm sorry, your security deposit back to you. But there's usually going to be some kind of small incidental that does require money coming out of that security deposit. I would plan on identifying what is one full month of rent cost. Let's say $2,000. If it's $2,000, I would estimate that the deposit you'll have to put down on this location is also $2,000 as well. So in order just to move in, you need to have that deposit of $2,000. You have to have your first month of rent for $2,000, and more than likely, not always, if you have a low credit score, you'll definitely need to have your last month of rent as well. So right out of the gates, that's $2,000 for your safety deposit, as well as another $2,000 for your first month of rent, as well as another $2,000 for your last month's rent. Just to move in at $6,000. I give students this rental application link to skim through and then come up with a question about one thing that they just don't understand or have questions about. What a rental application is a document that gives the landlord or prospective landlord the paperwork necessary for renters to complete and give them the information that they need to examine the employment, their credit history, references, any prior places that they've lived, so that this renter or landlord can make a educated decision as to whether or not you are the ideal applicant fit for the home that they will be renting out. If the rental application goes through and you've identified that home and you have the money set aside just to get inside of the home, you're in a good starting spot. Let's say that they choose you to rent that place. You now need to fill out what is called a lease agreement. And a lease agreement is a document that is legally binding contract between the landlord and the tenant meaning the person moving into the home. And it contains all of the terms for renting a house or an apartment. I give students a few minutes to skim through a lease agreement and type a question that they have about that lease agreement. On the move-in checklist, it is worth noting that on the lease agreement, there may be a ton of different things that pop up. This might state specifically pets, no pets, smoking, no smoking. You can have a barbecue on the patio, no barbecue on the patio. You can paint the walls, you cannot paint the walls. You are responsible for X, Y, Z. Quiet hours are a certain number of hours within the day. It depends on the landlord, the location, and other factors, and all of this will be spelled out in that lease agreement. Once you have filled out those documents and you're good to go, you will get the keys. But before you get those keys, they are going to have you go through and typically fill out this move-in checklist. The more detailed you are, the better off you'll be when you go to move out. This move-in checklist is where you will note any damage or anything that is a little bit off, miscolorations, dents in walls, stains in carpet, so on and so forth, so that when you move in, anything that's there will also be documented for when you move out, so you don't get charged for it on that security deposit. So by definition, this move-in checklist is a form filled out by the tenant immediately after moving into the new home. They'll usually give you about a week to note anything out of the ordinary. I have students tell me what they think are the most common things renters get charged for when they move out. For me, it used to always be window blinds. It didn't matter how much I cleaned those windows. Those window blinds were always going to be something that I would get charged for. Now that we have completed the entire rental process, saving money for that security deposit, saving money for your first and last month's rent, we've completed the application. We've also done the lease agreement and then the move-in checklist. Now it is time to pay for that last month as well as security deposit. I have students practice writing a rent check to whatever company it is within your region. And then I show them this. The way that I have them practice is using Pear Deck, which is interactive and allows students to write on the screen. And then I show them what that should actually look like right here. And at this point, they've got the keys. They're in a good spot. We then shift over to talking about renting versus buying, and I show them this Khan Academy video. You're welcome to watch it at your own leisure. We play a quick problem of the day with $1 million. You could get that $1 million, but you are obligated to live in a randomly chosen place on Earth. You cannot be gone from that place for more than 2 nights at a time. Where did you get? Would you and or could you do it? And once they click that link, it takes them to somewhere completely random on the planet. Kind of cool. I show them some of the upsides and downsides of buying versus renting. Biggest upsides being you could build equity, could in an asterisk, worth noting. You don't have a landlord. Nobody can tell you what colors you can paint your walls on the inside. On the outside, if you have a homeowners association, if you're part of a condominium complex or any kind of housing development that has an HOA, that may be something that you cannot choose on your own, but it is something to consider. There's some tax benefits of buying a home, both, and again, depending on where it is that you live, the tax that you pay, your property taxes each year, as well as any interest on mortgage loans, is deductible on your federal taxes, which we will talk about in an upcoming unit. You have stability, especially with schools. If you buy a home, you are not going to have to change schools if there's like some kind of rezoning or whatnot, as long as you are grandfathered into that setting. You can build your credit history with a different type of credit beyond just a credit card. This is an installment loan. The upsides of renting is that you have fewer upfront costs and less paperwork. You're typically not going to be responsible for maintenance or repairs that were not done by you, or damage that was done by you. It's easy to relocate if you need to. If the housing prices are falling, that's not your problem. And then we shift into asking students what is one thing that they know about buying a home. And so they start typing that in, and then I share with them a buying a house step-by-step guide. So these are the things that I start with. One, we need to build our credit, save some money for a significant down payment, research the inventory. We talk about location, location, location. What is needed in order just to buy a home? How do you get pre-approved for a mortgage? What is a mortgage? How do you get the legal representative called a real estate agent or realtor to help you find a home? How do you hunt for houses and then get the keys? I have them do some basic housing research using these websites, Redfin, Zillow, and MLSlistings.com, which is more specific to my local area, but I'm sure wherever it is that you live, there's a similar MLS type of website out there as well. And so our step for this is significant because we need to save some money for a down payment. You need to have money to give the bank as collateral to help you borrow possibly hundreds of thousands, if not millions of dollars. At a minimum, you'll likely need 3.5%. There's a couple loan programs out there where it's 0% down payment, and I'm personally not a fan of that. As a mortgage lender at one point in my career, I found that people that went into a 0% down payment type of housing structure, if there was a downside to the market and you put no money down, it makes it really difficult to be able to sell the house and walk away from it because you have no collateral in it. So let's say that the housing price drops by $100,000, but you put no equity into it. You now have to pay $100,000 just to sell the house. Generally speaking, the more money you put down, the stronger your lending options. 20% is generally the magic number that you need to afford you premium pricing as far as the best interest rates and most competitive products. We need to figure out where it is that we want to live based on your career path and where it is that you want to live. Do you have the income coming in just to make sure that you're able to buy a place in that location? And so when it comes time to buy, we want to make sure that we have a safety net in place. I call it a safety net, as in our finance banking unit. I discussed that you should set aside about 3 to 6 months of your safety net aside for the world of the what ifs. What if you lose your job? What if you get hurt and need to take a month off of work? What if things happen, your car breaks down? That safety net, 3 to 6 months, I usually park inside of a high yield savings account because it earns some interest. It's not subject to stock market volatility, which we talk about in a later unit. And I want to be able to have that money liquid so that if I have to take it out, if it was in the stock market, what if the market is down? I don't want to pull money out when it's down. I want to pull money out when it's high. So having it in that high yield savings account is a safer spot for me. I've already got that credit score built up. I have a stable job for at least 2 years. Sometimes, depending on the lender, you might be able to get away with at least 1 year, but 2 years is ideal, or at least it was back in my mortgage lending days. Do not apply for any new types of loans or credit cards because you want as little inquiries as possible on that credit report when they pull it. And then your debt to income ratio should be below 35 to 40%, meaning how much income do you make? And then how much will the debt percentage per month of all of your debt obligations, whether it's car payments, student loans, or anything else, in addition to how much your new monthly payment will be for this mortgage, taking all of those sums up. So let's say I make $10,000 per month in gross income. I need to have anywhere below at least $4,000, but ideally below $3,500 just to qualify. And then once I have all that in place, it's time to go get pre-approved for a mortgage at the bank. A mortgage, by definition, is an installment loan used to buy real estate. The parts of a mortgage loan is called PITI, PITI, kind of ironic, if you will, but the PITI acronym stands for Principal, Interest, Taxes, and Insurance. Principal is the amount of money the total amount that you need to borrow. So when you make your mortgage payment, you're paying down how much you actually owe left. Interest is just the fee that we have to pay to the bank to borrow that sum of money. Taxes is the fee that we pay to the government. It is worth noting that that is a tax deduction come tax time. And then insurance is the fee that you pay to protect your home. You don't only do that for you, you also do it as a requirement for the bank, because the bank wants to make sure if that house has any damage or something happened to it, that you don't stop making payments on that mortgage. So insurance is often a requirement. In fact, to the best of my knowledge, it's always a requirement from any lender that's lending you money for a home. As a rough estimate on the fly, for every $200,000 that you borrow, which is financed at 6 to 7%, which is what current interest rates are roughly around this time in 2025, you can assume a roughly $1,000 per month on a 30-year fixed rate mortgage. So if I needed to borrow $600,000, then I know that that's going to be approximately a $3,000 per month payment on that 30-year fixed rate mortgage. And that is, of course, subject to change, and it depends on how much the insurance is where you live, what the property taxes are, and other variables. This is an image that breaks down what that PITI looks like in graph format. And then I talk about briefly some of the different low down payment mortgage programs that are out there. If we're talking about bigger mortgages, and this also changes every single year, and we need to talk about non-conforming jumbo mortgages, but for the most part, many of these loans that are here are typically going to be associated with a lower type of minimum down payment. When we talk about different loan types, the most common terms you'll find are fixed rate mortgages, where they don't change. The interest rate that you lock into is set for the term or the amount of time that you take the loan out. The most common in the United States is a 30-year fixed rate loan. It's usually going to give you the lowest monthly payment because they take the principal amount and stretch out the repayment for a long amount of time. There are longer loans out there. I personally, it's my opinion, 30 years is the max I would ever go. They're easier to qualify for because the monthly payment is lower. They take the longest to pay off in full, and they are the most common, versus a fixed rate 15-year mortgage. Because we're paying off that same amount of money in a shorter amount of time, here's the beauty of the 15-year. If you can afford it, you'll likely get a lower interest rate. You'll pay way less interest over the life of the loan because it's not stretched over 30 years. You will, however, have a higher monthly payment because you're paying more money per month to get this thing paid off in 15 years. And then the last one is an adjustable rate mortgage, or also known as an ARM loan. These got a really bad rap in the Great Recession. And it's an unpopular opinion, but I just look at this. This is a tool. If you understand the tool and there's nobody trying to manipulate you into using the tool, and you know how to use the tool effectively, it can be an excellent type of mortgage product. For me specifically, if I was someone that knew that I was going to move in 4 or 5 years, maybe 7 or 8 years, I would consider an adjustable rate mortgage depending on what the economic environment looked like. These are all, or almost all, that I've ever encountered amortized over a 30-year loan. So it's still a 30-year loan, but what happens is that first number, so in this case a 5-1, the first 5 years are fixed, followed by the next 25 are subject to adjustability based on what the market is doing and Federal Reserve policy. In addition to that, you could also bump up to like a 10-1, where the first 10 years are fixed and then the following 20 years are adjustable. Many people will take out a 10-year or a 5-year and then go and refinance as soon as they reach the end of that adjustability or that fixed period. And so now that that fixed period is ended, they refinance their loan, they start a brand new 30-year or 15-year or 20-year loan, and they fix the loan interest in place. The monthly payments do stay fixed for the first number, so again, the 5 years or the 10 years, but then they adjust and change based on market conditions after that period of time. It is worth noting that the teaser, the reason that these can be a better deal is because you're taking on more risk, and risk and reward are directly related. Since you're taking on a greater risk, they'll oftentimes reward you with a lower interest rate than you would on a standard 30-year fixed rate. This gives you an idea as to what loan documentation looks like for someone with good credit versus bad credit, similar to what we discussed in the credit union unit. The different scenarios are somebody with an 800 credit score versus that of somebody with 600 credit score. If you've got an 800 credit score, the mortgage lender will ask you for a year of tax returns, your W-2s, which we talk about in our tax unit coming up, 2 months of bank statements, sometimes one, letters of explanation for anything goofy showing up on your credit report. If you have any different aliases or names, spellings on your credit report, or weird address configurations, they may ask for that. Maybe a reference, as well as a month of pay stubs to see your year-to-date income, as we discussed in Unit 2 pay stubs. And if you have a 600 credit score, everything increases. Your documentation increases, your interest rate increases. It all gets more complicated and more expensive because that interest rate, when we're borrowing hundreds of thousands or millions of dollars, makes a significant difference. But for the documentation alone, now we'll need 2 or 3 years of tax returns, multiple years of W-2s, 12 months of bank statements, letters of explanation on why you missed payments, because if you have a 600 credit score, there's something going on there. If you have any child support or alimony or court orders or anything like that, multiple references, 12 months of pay stubs, 12 months of credit card statements, and the list goes on and on. This is all subject to variability based on what your individual circumstances are. And it also depends on what the financial institution's requirements are. But the bottom line is I'm trying to show you the benefit of having good credit versus bad credit when you go to buy a home. Once you are pre-approved by that mortgage lender and you've given them all the documentation, they give you a piece of paper that says you are pre-approved for this amount of money. Before you just go out and start looking for a house, you'll likely want to connect with a real estate professional, and that real estate professional will more than likely be defined as a realtor. That is a trademarked licensed name, so maybe they won't be, but most of them will be a realtor, and this is a person who acts as an agent for the sale or purchase of a real estate transaction. They're also called a real estate agent. They help you find a home, make a legal offer, and they'll also help you evaluate how much your home is worth when it is time to sell it. You'll have a real estate agent on the buying side and a real estate agent on the selling side, unless one real estate agent does it. There's, depending on state by state, there's some different parameters around that too. Now that you have the agent, it's time to find the house. Once you find the home, you make a legal written offer. If the seller accepts your written offer, now we open up what is called escrow, where the buyer of the home will put money into the escrow account. They fund the escrow account. Escrow is just part of the title process where we're transitioning the title from the seller to the buyer. And the reason that they do this is they want to make sure there's a trusted, non-affiliated party in between. It's the middleman that makes sure that everybody stays safe and that nobody gets swindled in the deal. And so the buyer places their earnest money deposit inside of this escrow account. The escrow agent or title agent makes sure that the title on the home is clean. Once the seller has confirmed that everything is as they say it is, that there's no liens against the property, nobody has a lawsuit against the property, the escrow agent will release the money to the seller. That escrow agent also received the remainder of the money from the bank, so that there should actually be in the top left corner an extra picture of a bank up there, moving the remainder beyond the buyer's deposit. Also, the bank is putting the rest of the money in there. The seller then receives the funds and the assets get transferred over to the buyer. If there's a loan on it, it's worth noting you don't actually own the home until you pay it fully off. The bank owns the home. They get the deed to the house. It's recorded with your county clerk as a deed to the bank. But at the same time, do know that once you pay it off, it becomes yours. That title company will help you open up the escrow account. They receive and print all the loan documents from the bank. They coordinate the signing for the buying and selling parties. They have a notary public there, depending on the state that you're in. You may have a state where you actually have the buyer and seller sitting at a table. There's different ways of doing that. The title company will ensure that the title is clean. They'll transfer the title over, record it with the county, pay any of the realtor's fees out to them. It is negotiable, but usually 6% of the total home sale price, 3% to the listing agent, 3% to the buyer's agent. Where we live in California, home prices are unbelievable. In Monterey specifically, 5% seems to be the peninsula norm. So 2.5% to the buyer's agent, 2.5% to the seller's agent. And at this time, once title is clear, it's time to get the keys. You pack up, you move in, and you set up your bill pay. And then we move into the assignment beyond the guided notes that students do in my guided note packet that I gave them earlier. I have them identify a property for 22-year-old them using Zillow.com. They figure out what the address is, how many bedrooms and baths it is, square feet, is it rented or for rent or for sale, how much is the monthly rent or monthly mortgage payment. They take a screenshot of the home, and then they also identify a dream home and then see what the Zestimate is. At the end of it all, they write a rent check for the home that they found, and that rent check that they use, or mortgage payment, PITI, is what they will use for the final document that is to be submitted at the end of the semester. That concludes this presentation on real estate for my personal finance money management class. I am Max Feldman with the Business Teachers Toolkit. Send me an email or ask me any questions should you have any. If you're a student out there, do see me in class for any further support. And if you're one of my teacher colleagues out there, Send me a note if you've got any questions. All the best to you. Thanks.